Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump is threatening to impose fresh tariffs on agricultural products, including Canadian fertilizer. Speaking at a White House event to announce billions in new aid for U.S. farmers, Trump suggested he could target fertilizer imported from Canada to boost domestic production, saying the U.S. could impose very severe tariffs if necessary. Tariffs on fertilizers, largely sourced from abroad, could renew concerns from American farmers. Now, Canada is the U.S.'s biggest supplier of potash. Shares of Group Dynamite are surging today after the Canadian fashion retailer delivered results in its third quarter that blew past expectations. You can see it's up more than 10% right now. Profit and revenue topped estimates, while same-store sales rose more than 30%. Dynamite says the results were driven by strong demand as well as new store openings. The company also raised its targets for the year for comparable store sales and profit, and has also declared a special dividend. Brookfield and Qatar Investment Authority are teaming up on a $20 billion U.S. venture to invest in AI infrastructure in Qatar and select international markets. The American firm has been among the most active foreign investors in the Gulf in recent years. Last month, Brookfield announced the launch of a $100 billion U.S. global AI infrastructure program in partnership with NVIDIA and the Kuwait Investment Authority. Shares of Campbell's are falling today. The food and beverage company posted lower profit and revenue in its latest quarter. Campbell says at-home cooking trends continue to benefit its meals and beverages divisions. However, the snack business continues to face soft demand. The American company will acquire a 49% interest in La Regina, the maker of aroused pasta sauces. Campbell also reaffirmed its full-year guidance for 2026. Quick peek at the markets right now. Turnaround from the start of the day. The TSX up by more than 0.6%. And south of the border, it's a similar situation. Everybody in the green. S&P 500 up by about 0.2. Dow up by more than a quarter point. And NASDAQ also up by almost 0.2%. U.S. President Trump is threatening to impose tariffs on Canadian fertilizer while announcing billions in new aid for U.S. farmers. Trump suggested he could target fertilizer imported from Canada to boost domestic production. Let's get more insight on this from Norman Levine, portfolio manager of Brook Wagman Private Health Management at Raymond James. And Norman, thanks very much for joining us.
Thank you. Nice to meet you, Roger.
How real is this? How realistic is this move?
It's not realistic at all. The U.S. produces a tiny fraction of the fertilizer it needs for its farmers, and its reserves are very small. And as we know, in Saskatchewan right now, BHP is developing what's called the Jansen mine for potash, and it's taking many years, and it's going to cost them untold billions of dollars to get it done. So for Trump to say he's going to put tariffs on Canadian, and he didn't specify Canadian, on fertilizer, especially potash, means that farmers in the U.S. are going to be suffering, and that means that prices for consumers for fruits and vegetables will be going up, and not going up a small amount. It's nonsense. It makes no sense.
Is this a political move as we get ready to renegotiate CUSMA or the USMCA or the MUSCA, MUSCA, whatever you want to call it?
We never know what he's doing and why. So yes, it's possible it is, but he won't be bargaining from a strong position on this. As I say, they need imports. They can't do without imports. And they can't do without a lot of imports. So to threaten this I don't know, maybe he just got up on the wrong side of the bed yesterday because it made no sense.
All right, and bigger picture, I guess, how are things to you looking? This is just one small part of it, but how are the markets looking around the world? Are we facing a 2026 that could be a little darker than some people want, or is it looking like there's optimism?
I am optimistic and I'm pretty fully invested. And the reasons are that world economies are not going into recession. There were predictions were that the recession's coming. They're not. Uh, Employment numbers are better than expected. Corporate profits are much better than expected. And you're seeing interest rates starting to rise, excuse me, in the longer ends, the 10 years and 30 years, going out, steepening the yield curve. And that's a very positive sign for world economies, which tells me that stock markets have further to go. All stock markets are not equal, and all parts of stock markets are not equal. I believe that we're getting a rotation now out of the Mag 7, a lot of the high technology stocks, and broadening that out into more defensive a bit with healthcare, with cyclical, with mining, with energy. And you're starting to see world markets outperform US markets, and the small cap markets in the US, was something I want to talk about, are also starting to outperform.
And the world markets have actually, if I'm not, for the last year at least, they've outperformed, have they not, the American markets?
Yes, they have. And one of the ones I wanted to talk about today was the Israeli stock market, the Tel Aviv stock market, which since shortly after the October 7th, 2023 Hamas massacre has more than doubled off of that. And it's because the Israeli economy is very resilient. Israel, as peace breaks out, and it is breaking out, and it'll be fits and starts and will take time, but the Israeli economy will be the major beneficiary of peace in the Middle East, and Israeli companies will, and it's not an expensive market, so both the stock market and the shekel, the currency, are going up. I've owned it since shortly after October 7th, still own it. It's in some of my portfolios the biggest holding, and happy to own it and still tell people to buy it here.
And is it being driven by defense sector, or what is fueling this?
Defense is part of it. The biggest parts of the stock market are banks and technology companies and drugs. Teva Pharmaceutical is the fourth largest holding in the Israeli ETF. So yes, Elbit and some other defense companies are in there, but they're actually right now not the leaders. It's the banks, the healthcare, and technology that are doing it.
I had a chance actually to watch the documentary on Technion, the university there, which they equate to MIT, and the tech sector and health sector that's tied in with it is pretty impressive in Israel.
What they come up with there is unbelievable. Most people who are watching you have no idea what parts of products they use, what drugs they take, what technology they use comes out of Israel. They would be, it's mind-boggling, and they don't know. So it's a very advanced economy there.
And when you're looking at Israel, are there certain stocks you like more or sectors you like more?
No, I don't want to pick stocks in a foreign stock market too often. So I buy the EIS, which is the Israel ETF. It trades on New York.
And what do you like about that?
Well, I like that it's a broad representation of the Israeli market, and the fee is low, and I just like the market itself there.
Okay, Norman, thank you very much for joining us today. We appreciate it.
Thank you, Roger. Nice to be on with you.
Norman Levine is portfolio manager at Brook Wagman Private Wealth Management with Raymond James. Well, coming up, Microsoft is making a big investment in Canadian artificial intelligence infrastructure. We'll have more when we come back. Microsoft is investing more than $7.5 billion in Canadian AI infrastructure throughout the next 2 years. The new capacity is expected to come online in the second half of next year. We got more from Benjamin Klein, Senior Portfolio Manager at Baskin Wealth Management.
Makes a lot of sense for more AI investment and AI infrastructure to be built in Canada. And we have the power generation. We have, of course, the preferable climate, keeps it nice and cold without having to pay anything. We think this is a very reasonable, by Microsoft. Hopefully, there's more where this came from, and it can move the needle for the Canadian economy as well. But we think this is a win-win for both sides.
It's interesting. The Microsoft PR department have been busy. So they're saying if you include investments since 2023, this will bring them up to $19 billion Canadian, or about $14 billion US. However, at the same time, they're pledging almost $18 billion in India for AI cloud. So they're trying to, I guess, reassure governments around the world, hey, we're going to be spending on AI within your borders.
Yep. I mean, if there's if this is just the beginning of the tip of the iceberg, so to speak, there's plenty more billions where that came from. So you might as well make as many governments happy as you can.
Yeah, and we hear this talk of AI sovereignty. Countries don't want to be left out, but we just don't have the capital in this country to emulate what the US is spending on data centers.
Yeah, I mean, this is, I think, a lot of the investment is going to come from companies, particularly based in the States, like your Microsofts and hopefully your Amazons and other providers. This is a good start. Hopefully, there's more where it came from.
You're in the camp that says the Bank of Canada stands pat tomorrow with no cut in interest rates.
That's right. I don't think we have a contrarian view. This seems to be very much the consensus expectation. The economic news, I think, has been better than most people anticipated. Obviously, we've had a couple of quarters of pretty strong job growth and positive GDP surprise in Q3, which is very nice. I don't think there's a lot of downward pressure, at least for this rate announcement, but I think the expectation remains, at least for us, there will certainly be pressure on rates in 2026. Will they go down? How many hikes and how much? I don't think anybody can really hazard a guess on that, but we expect no change tomorrow.
You like the look of Netflix. Of course, they may have a tough job buying Warner Brothers because of monopoly concerns in streaming, but generally, you think it's a great business to own?
Exactly. So, on the whole, Netflix we still think is the best-in-class media business. It has the strongest growth. It has the best profitability. It has a huge lead in technology, a huge lead in scale. They have a creative management team, always looking for not just adding new content, but adding more content types like video games and other things to the platform. Mm-hmm. We think this could be a tremendous opportunity for Netflix. Obviously, yes, there's the regulatory issues to worry about to see if it goes through. But we think that if it does go through, Netflix has really all of the tools to fix HBO Max's problems, more or less. And they have HBO Max has the best content. They're the gold standard for content, but because of their lack of scale, they've really found it difficult to make money. A lot of their subscribers, of course, get it through just distribution bundles. So Warner Brothers doesn't collect the full subscription fee on that. And we think that Netflix, by utilizing their advantages again in technology and scale and their free cash flow to invest in the business, can really turn things around for them. They can even, of course, they're going to be almost certainly required to keep them separate, at least for now. So your James Camerons, your Christopher Nolans can keep their theatrical window. And we think, again, this is a tremendous opportunity for the business. And we think Netflix is almost certain to say, look, we are going to agree to any regulatory demands of us because it's such a great opportunity.
Still, there's got to be concerns about movie windows because Netflix has such a strong incentive to get them on its platform and have movies running a very short time in the theaters.
Yeah, and of course there are going to be a lot of different details that need to be worked out. But we think that if part of the issue is theatrical windows and streaming for going to streaming after a certain number of weeks or months, we think that Netflix is going to be very willing to make any concessions needed because it's such a great opportunity for them.
Adobe is such a fascinating story. They've had a miserable year. But of course, they have a lock on the professional graphics, and they're big in video editing. So you think, wow, look down almost 40% in the past 12 months. You think investors are missing value here?
Yes, it's been a very rough ride for the stock, no doubt about it. They're reporting earnings this week. This is really, for us, not a hugely complicated thesis. We think the company is dramatically undervalued. This is a company that is growing at double digits, capital light, recurring revenue business, great margins, and they're trading well below market multiple. You really cannot find opportunities to buy a company that's consistently growing at double digits, it has been for years, and trades at a valuation as cheap as Adobe. Now, of course, there's a reason. The narrative is that this company could potentially be in trouble from AI image generation and various other kinds of AI disruption. Management has been very clear and very plain. They have not seen any of this yet. Could it change? Of course, going forward, yes. But we think it's at least as likely that Adobe is able to leverage AI in their own suite of products in Photoshop and Illustrator as being disrupted by some kind of outside force. So our view is this is a dramatically undervalued company. We think market sentiment will turn as they hopefully continue what we have seen to be strong earnings, and we think there's a lot of upside for the company.
And he was speaking with Benjamin Klein, Senior Portfolio Manager at Baskin Wealth Management. Coming up, today's market drivers with Bloomberg's Monique Malima. Some of today's market movers. We're joined now by Bloomberg Equities reporter Monique Malima. Monique, thanks as always for joining us. Let's get right to it. 21 Capital having a bit of a rough start, rough debut.
Yes, so 21 Capital, this is their first day of trading today. They merged with Cantor Equity Partners, which is one of the sub-companies under Cantor Fitzgerald, to create a new Bitcoin treasury company. The new company has about $3.9 billion of Bitcoin, but their shares fell around 25% when they started trading as this new company today. It's been a difficult time for the crypto industry. Bitcoin prices have fallen quite a bit from earlier this year. There's been a lot of liquidations in the market. And for Bitcoin treasury companies in general, there's just been so much competition. So it's made it a difficult time to start a new business in this area. So that's why we're seeing some pressure on those shares today. And this is also something that's being done not just with Cantor, but also with Tether, which is one of the largest stablecoin operators, and with SoftBank. So a lot of big names working on this deal together for this new company, but their shares struggling a little.
Okay, Galaxy Digital, it's up nicely today so far.
Yes, so Galaxy Digital, they're also a crypto company, but they're more on the exchange side and also in some financials as well. And they got a street high price target today from Citizens at $60 per share. This is a big upside from their current share price. And Citizens really sees a lot of opportunities for growth for the company going forward. They see there's going to be new opportunities on the crypto side. The company has a large institutional business, and they see that there's not going to be a lot of opportunities for other competitors to quickly scale to the level that Galaxy's at, especially as institutional adoption is expected to increase going into next year. They also see a lot of opportunities on the data center side. Galaxy has a deal with CoreWeave for a data center in Texas, and the analysts are pricing this at around $35 per share, and they say that there's even more opportunities if Galaxy goes further into this data center space. There's a lot of demand right now for data centers for things like AI, but they also note that if this data center business is kind of starting to outpace some of the growth seen on the crypto side, then maybe it might need to also be separated out to fully get all of that value in those shares.
All right, let's look at one of the OG, ExxonMobil.
Yes, so Exxon, they gave their updated outlook through 2030 today, and that's what's really boosting their shares today. They upped their expectations for earnings and for cash flow. And analysts are really highlighting the fact that even with these growth that the companies expect to see, CapEx is still going to be in line. So the capital expenditures aren't expected to be risen more than they were previously thought to be. So they're seen as something really positive for the company. They're expected to see growth in the Permian Basin, in Guyana, in natural gas. And the company is also now going to be pulling back on some of its carbon ventures. There's been a lot of kind of uncertainty over the policy surrounding carbon and kind of some of those environmental aspects of the energy space. So they're reducing some of the investments there and putting some more into these other high growth areas, which is what's helping push the stock higher today.
Okay, we'll leave it there. Monique, thank you. As always, Bloomberg's Monique Malima. Well, Group Dynamite says it delivered unprecedented Q3 results with growth in comparable store sales and an increased full-year guidance. For more on it, we're joined by BNN Bloomberg's Lindsay Biscaya. I guess it was a dynamite kind of. That's for the old. That's really old. That's from the 70s. That's the. That's good times.
Yeah, good one.
Dynamite.
Good one.
I'm just going to leave it there.
That's the first time I've heard that today. I'm surprised that took so long actually to come up, especially for me and Andy.
From
you and Andy,
yeah.
So we're talking about the retailer Group Dynamite, which is behind Dynamite, the clothing store, and also Garage. And Dynamite says most of the tariff volatility appears to be behind them now, and that's why we're seeing such a strong Q3. It is interesting. They're seeing people still coming out to shop. They're seeing high traffic both in stores and online. That's according to the company, and they expect that to continue now as we are well into the holiday season after Black Friday. A lot of retailers saying the same thing. They're not seeing shoppers slow down, despite that uncertainty around tariffs around the economy, around tariffs that we're seeing right now. You'd think people would be kind of maybe trying to save more. People are still spending, apparently. These are according to many retailers, including Group Dynamite. So for the third quarter, profit rose compared with a year ago. So comparable store sales were up 31%. Revenue up 40% to $363 million. That's up from $258 million in the third quarter of the prior year. And the company is saying most of that is actually driven by new stores. They did add 8 new stores in the U.S. this year. So now there's 176 stores in Canada in total, like Garage and Dynamite combined, and 131 in the U.S. And the company's also touting that there was no store closures in the last quarter as well.
All right, so pretty good numbers all around, and they changed their guidance for 2025
yes,
as well.
They have. So again, the company's saying this is a sign that they see strength in Q4. So they raised their guidance for its adjusted EBITDA margin for the full year. So now it's between 35 to 37%. That's up from 32 to 33. They also raised comparable store sales growth guidance range to 25 to 27%. That's up from 17 to 19. This is assuming that trade relations remain stable. There's a earnings call going on right now with the company. So it's ongoing. I'll listen in and see what else they have to say. But they were saying in this earnings call that, they have raised their guidance, assuming everything stays stable. And we will have to see if that actually happens. And I mentioned stores. The company is also expecting to increase its number of stores in the next few years. Right now, they've got 307 combined across Canada and the U.S. But by fiscal year 2028, the company says their goal is to have 350 stores. So obviously, it looks like it's a rosy picture moving forward. That's according to the company right now. More stores coming and raising its guidance for the year too.
Makes you wonder how well the retail industry is doing. We've heard mixed, we've heard fears about it, yet they seem to be.
It's interesting so far. And again,
gangbusters.
The future is uncertain when it comes to trade in the economy, but a lot of retailers saying right now, as long as it remains stable, we're good.
Things are good. Stable. Okay, Lindsay, thank you for that.
Thank you.
BNN Bloomberg's Lindsay Biscaya. When we come back, Canadian fertilizer is next on the Trump tariff chopping block. More on that after the break. Microsoft will be adding to its AI investments in Canada with a total of $19 billion US between 2023 and 2027. The tech giant will build new digital and AI infrastructure in the country with new capacity set to come online in the second half of next year. Microsoft is also launching a new 5-point plan to promote and protect Canada's digital sovereignty, including protecting Canadian data from other governments, including the US. Home Depot shares are up slightly in the light of the company's recent predictions. Home Depot forecasted fiscal 26 comparable sales growth and profit below analyst estimates as demand for do-it-yourself projects and big-ticket items decreased. U.S. housing demand has also been choppy due to rising unemployment and high home prices. However, Home Depot's finance chief said the company expects that the pressures in housing will correct and provide the home improvement market with support. Shares of Campbell's are falling today. The food and beverage company posted lower profit and revenue in its latest quarter. Campbell says at-home cooking trends continue to benefit its meals and beverages divisions. However, the snack business continues to face soft demand. The American company will acquire a 49% interest in La Regina, the maker of Rao's pasta sauces. Campbell's also confirming or reaffirming its full-year guidance for 2026. And taking a look at the markets, you can see the TSX bouncing back is up 0.63%. It's being led by a lot of mining companies, silver specifically. Just pulling a couple here. Pan American Silver is up more than 8% at this time. Aya Gold and Silver also. Actually, you can see Pan American now is up 10%. And Aya Gold and Silver is up more than 8%. And that's because spot silver prices hit records above $60 an ounce. Traders are, of course, betting on the monetary easing by the Federal Reserve, and there's also a supply tightness. It topped $60 briefly. It rose 3.2% to that, and it's more than doubled this year alone. Let's head down to the quick look at the American market, see what they're doing before we move on here. There you go. In the green down south of the border as well right now. So U.S. President Donald Trump announced more aid to U.S. farmers amidst growing costs for exports, and he's eyeing more tariffs on items, including Canadian fertilizer, potash to be specific. Here to talk about that and its effects on CUSMA renegotiations is Jacques Shore, Government Affairs and Trade Specialist Partner at Gowling Law Firm. And Jacques, thank you very much for joining us. We appreciate it.
My pleasure. Thank you, Roger.
I asked this question before. Is this realistic? Will we see this actually happen?
Well, we're in a roller coaster ride. Not easy for business, not easy as we try to figure out how we're actually going to deal with the upcoming real negotiations when they take place in 2026 as to where we go with CUSMA. But I think under the circumstances, what this demonstrates is, yet again, how far are we? Where are we with regard to our pressure points? And this is a new avenue. We've not really seen potash or fertilizer, if I may say more generally, as one of those areas that one would look to as to provide a bit of a threat. Look, these are sort of the waning hours of 2025 as we get into 2026 and really look at where this is going. I tend to feel that with everything that is going on, it would be hard to imagine. Again, difficult to know exactly where President Trump will be going in this, but hard to imagine that with something like fertilizer and potash, that there would be a risk really to U.S. farmers in the context of something like this. They need our potash. It is one of the things that can't be produced in a way in the United States. There is essentially 80% of what they receive is from Canada, from Saskatchewan mostly. Mm-hmm. And the fact is that U.S. imports of potash 90% essentially. So this may not be the area where one would really suggest a real serious way of dealing with this. But what it does, I think, demonstrate, though, is that we are in negotiations at the moment. I think our Prime Minister is doing as well as he possibly can in these circumstances. Last Friday was a good day. It appeared that both President Sheinbaum of Mexico and our Prime Minister had what looked to be very positive discussions with the President as he described it. So we have to sort of fasten our seatbelts, recognize that we are in this game. I described it as basically a good full 9 innings, maybe some extra innings along the way. And here we are with something to think about.
And I think with the extra innings, there won't be a guy on second base either. This is essentially CUSMA starting early. How rough and tumble do you see these talks getting?
Well, great question. They already are rough and tumble, aren't they? I mean, just think about the fact that so many people are thinking about this. Look at the amazing amount of time that, business leaders, others are weighing in. It's tough. These are very, very difficult moments. frankly, moments that I can't recall anything quite like this, because we have such a fantastic trade relationship with the United States. We are the envy of the world. 93% of our trade is actually in CUSMA. That's the big question. If we find ourselves effectively in a tariff-free environment with continuation of CUSMA, I still think it's the right way to go, because, and it will happen because it's what's so logical. I think it's good for the Americans. I think it's good for us. But at the same time, to your point, in the context of a rough and tumble that we're in right now, we are working very hard at diversifying our trade activity. I've just been in Europe twice over the last month addressing some of those issues. I see that there's a strong effort by the Europeans to work closely with us, but we need to be mindful. The Americans are still our great friends, and understandably so. So we have to actually sit down, work through these things together, understand that they have certain pressure points that we need to be mindful of, and come up with something that really makes sense for both countries.
And with that combination, are Europeans looking and saying, you know what, we're interested maybe doing business, but are you just going to jump back to the U.S. once this is all resolved? And they're holding off as well.
Well, I think, over the last number of years, we have been talking about diversifying our trade, and that's only natural. But I think that this is something where we feel maybe even a bit of a kick in the gut, where we have to understand we do need to do more elsewhere and rely on working with other like-minded countries elsewhere. And that could be a good thing for the United States as well. The way in which we have our trade arrangement with the United States means that if we have companies from Germany, from Switzerland, from France, others that step up, they also have an ability of being able to work with us and into the United States and grow those opportunities in the way that I think makes a lot of sense. I think we have learned a lesson here, and it's a good one, but at the same time, I can say there are positive elements of that for our American friends as well.
And of course, as we go to the table with the U.S., it would be nice to have that in the back pocket, that we have alternate deals and possibilities. Do you see CUSMA getting resolved by, how long do you think it's going to take to renegotiate CUSMA realistically? And do you think it will survive?
There's a time frame. So what I also say is education. We have to make sure that, those in U.S. Congress, governors, others, they really do need to understand the importance of this trade relationship. They need to understand that, it has served us well, and of course we can tweak those issues. So they have to be the ones, in a sense, more so than Canadians, as the advocates of appreciating the importance of the kind of trade that we've had essentially for the last 40 years in ways that are positive. I continue to be positive. Roger, I think that it's the right way to go. It's the way in which we approach negotiations. We need to look at that, the way in terms of what do they need. We have lots that we can offer. As a sovereign country, one will continue to be sovereign and strong. We can actually say, we understand that there are certain things that they require for it to work. I think that we're looking at a set of negotiations that aren't necessarily easy. I have a lot of confidence in those that are speaking on our behalf. But again, I repeat, it's those Canadian businesses working with those legislators, other businesses in the United States, to make sure that there's clarity in the way in which they express the need for us to continue this trade relationship that we have.
Okay, we'll have to wrap it up there. But Jacques, thank you very much for joining us.
My pleasure. Thank you, Roger.
That was Jacques Shore, Government Affairs and Trade Specialist Partner at Gowling WLG. Coming up, the U.S. green lights more sales of NVIDIA chips, but China is pulling back. We'll talk about that with our next guest after the break. U.S. President Donald Trump is allowing NVIDIA to sell advanced chips to China, marking a shift in U.S. tech policy. High-end H200 chips are getting the green light, but China is set to limit access. Here to talk about that is founder and CIO of Spear Invest, Ivana Delevska. Ivana, thanks as always for joining us.
Thanks for having me, Roger.
Okay, many angles to this. First up, NVIDIA. Is this a win for NVIDIA?
Well, Roger, just for background, NVIDIA was expected to sell approximately $17 billion to China this year. That got brought down to zero. So in the current analyst estimates, there is nothing really included for China. So versus that, it's a pretty significant incremental positive. Now, it does come with a lot of questions that we don't know the answer to. And those are whether China will be encouraging the sales of these chips or discouraging them. And that's really what the market is a little uncertain about, in addition to the 25% tariff. So it sounds like it may be a little bit too late for NVIDIA to penetrate this market, but still a lot of details to come.
I know we're already seeing China is apparently considering limiting access to it. You'd have to get a permit and explain why you need it. How detrimental would that be?
Well, NVIDIA chips really are very strong for general purpose computing. So anytime you need NVIDIA's CUDA software, there is really no better substitute for it. So from that perspective, I think it would be in the Chinese best interest to allow the sale of these chips. However, every time you have a situation where it's not really a free and open market, it's not as easy for the company to penetrate it. So I think it's not necessarily detrimental. It's just not going to be a very big positive surprise for the stock. I think if they were able to really penetrate the market in a more free market type way, China could be a really big opportunity for NVIDIA. But thus far, with this sort of frictions and tariffs, I don't know that we will be able to see a meaningful impact in the numbers. And this is why you see the stock not really responding all that positively to the news.
Now, there are critics of Trump that are concerned that this could help China win the AI war if they get these chips in it, because they're considered they're ahead when it comes to AI. Is that the case, do you feel, or is China still a long way off? They're still a generation behind when it comes to chips. Is that holding them back?
Well, Roger, I think in our view, the way to win the war is with continued innovation. So it's really all about staying ahead on the innovation front rather than restricting sales. So I don't necessarily think that allowing the sales to China will be able to accelerate China winning the war, because if they're not provided, then China would develop them internally. So at this point in time, really, I think NVIDIA being the dominant platform would be a lot more beneficial to the US versus China having their own chips developed internally. And just to provide some background here, at this point in time, many companies know how to make these chips. So it's not really a secret. Mm-hmm. It's all about how quickly they can advance them, how quickly they can provide features that are beneficial to different use cases. So we're really beyond the stage where NVIDIA was the only game in town. You see competitive chips from TPUs from Google or the AWS chips, same with Chinese competitors. There are many alternatives to GPUs today. However, NVIDIA still wins in that general purpose computing. So if you are making these chips available broadly, the more likely you're able to establish dominance. If other companies or Chinese competitors develop this in-house, then they would obviously have that advantage.
And does this say anything about the bigger picture for AI and concerns about a bubble in the tech sector? Or is this just the next move in this situation?
Well, I actually think that all the developments that we've seen over the past year have been very positive for the AI cycle. And I don't really see a bubble anywhere you look at in the value chain. If you look at NVIDIA valuation specifically, it's trading actually at the low end of its valuation range. And some of it is because of all of these concerns that we highlighted earlier. But if you look at the sector more broadly, you're seeing a lot more innovation. You're seeing companies come to market. You're seeing a lot of benefits across the value chain. So this is where we're finding the most investment opportunities. So companies in the networking space, whether it's on the electrical component side, optics, power generation, this is where the bottlenecks are today, and that's where most of the opportunities are. So we disclose all of our holdings on our website, and some of these companies, you'll find them there.
And now there were some concerns that if they didn't allow the chips to go in, that China would catch up, build their own internal system. Is China catching up when it comes to chips? Will they be able to catch up?
Yeah, absolutely. So they're definitely catching up when it comes to chips. They're catching up on the hardware side. They're doing very well on the networking side. So that's another area where we've seen, even if the chips themselves are not performing as well, once they're connected as a system, they're actually having pretty comparable performance. I think where NVIDIA is really differentiated is in providing these frameworks that sit on top of the GPU. So when you hear Jensen say, hey, even if we were to give away the chips, even if competitors were to give away the chips for free, our product will still be better. That's where that comes from, is these frameworks that are free and come along with NVIDIA's chips. So I think Chinese competitors will catch up on the hardware, like bare metal performance side, but they're still going to be missing some of these frameworks, which is really what allows competitors or new entrants to develop AI products quickly.
Okay, we're going to have to leave it there, but Ivana, thanks as always for joining us. Ivana Delevska is founder and CIO of Spear Invest. Coming up, Hot Picks. We'll look at 3 plays in the commodities sector when we come back. All right, time for Hot Picks, and we zeroed in on 3 plays in commodities with Taylor McKenna, analyst at Coppernet Global Investors. We kick things off with his first pick, K+S.
They're a potash producer, and the reason why we like it is if we look at potash, right now it's trading well below the incentive price, around $330 a ton. To increase the supply, to build new mines, you're going to need a price well above $500 a ton. And as long-term investors, if we look out 5 years or so, you'll be in a shortfall. So there will be new mines that need to be built. Prices will have to rise. And in that environment, K+S has a very good mine in Canada and then some middle to higher cost mines in Germany. But with those middle to higher cost mines, they have incredible optionality to these likely higher prices in the future. They also have a very strong balance sheet, so they can weather this storm that they're in right now. So we see a lot of upside in the future.
Actually, maybe we could put up a quick one-year chart for Nutrien. You probably saw that story that U.S. President Donald Trump mused about putting tariffs on Canadian fertilizers, but he's been going to and fro. He issued an executive order just a while ago to cut tariffs on imports of Canadian potash. And so he's been cutting them now. He's apparently talking about increasing them again. I see the Nutrien investors are taking the news in stride.
Right. We also like Nutrien a lot too. So they have incredible assets in Canada, very low on the cost curve, very well managed overall throughout this cycle. I think it would be pretty hard to put tariffs on fertilizer from Canada because U.S. farmers rely on this so much.
Right. We're tight for time, and I'm sorry about that. Valterra Platinum Holdings. What draws your attention here, Taylor?
Sure. I was listening to your previous guest, and he was making a lot of good points on the fundamentals continuing for gold into the future. And we agree with that. We still like gold, but we actually see a lot more upside in platinum for some of the same reasons. Historically, it's traded at a 1-to-1 ratio to gold over the long term. It's at a 60% discount to gold right now. You're seeing jewelry demand and investment demand really pick up throughout this summer and into this fall. So there's a lot to like there when you compare it to gold, at least historically. Importantly, on the supply side, it's always important to look at the supply side when you're investing in these metals. The supply side is pretty dire at current prices. So you'll need much higher prices for reinvestment to occur in the core market of production, with its South Africa likely north of $2,000 an ounce, and we're here around $1,500. Getting back to the company Valterra Platinum has incredible assets, some of the best assets in the world. They're in South Africa. They're the largest platinum producer in the world. They have a very good management team and a strong balance sheet. So they're doing okay at current prices. But if prices rise, that would foster new investment, which is likely to happen. They have incredible optionality like K+S.
And then finally, Glencore, a giant name in metals.
Sure. Glencore we view it as a sum of the parts nature. They have an underappreciated copper portfolio in our mind. They bought in some great assets, some brownfield assets over the years. And as everyone wants more copper, they're going to be increasing production over the next 5 or 10 years, particularly in Argentina. They also have one of the best coal portfolios in the world. Some of those assets are in Canada that they bought for Teck at a very, very good price. We're going to need coal for a while longer, especially these met coal assets in Canada. And then, of course, they have the trading business, which gives them solid cash flows and allows them to buy back stock at depressed value. So we see from some of the parts value a very good opportunity in Glencore right now.
And of course, we're almost out of time, but major shakeup in the metal market with it. Looks like Anglo American is going to get Teck Resources. Of course, the votes have still to be counted.
Yes, it does. It does seem that way, and it looks like the company will be headquartered in Canada. There's some very good assets within Teck, but Glencore surely got some great coal assets very cheaply.
All right, Andy was talking with Taylor McKenna, analyst at Copernic Global Investors. And let's see how the markets are shaping up for Bay Street, Wall Street, and of course across North America. But right now, looking at the TSX, you can see it's up. It's having actually a nice day, 0.64%. Almost every sector is in the green. What do we got? 6 out of 7. Infotech leading the way. Materials as well. They're up almost about more than 1% and almost 1%. And a couple of the watch for silver has been driving things. And if we're going to pull up Pan American Silver Corp having a good day right now, if we have that. And it's all in response to what's happening with silver right now. It topped $60 at one point and might still be trading above it. And that is a record high. In fact, it's more than double. There you go. You can see Pan American Silver is up 11%. All of this on everybody taking advantage of silver. There's a lot of need for it and also expectations of the Federal Reserve. And a quick look at Wall Street before we go. In the green as well for everyone there. Market calls coming up next. Today on the show, we have Hap Snedden, President and Chief Portfolio Manager of Castlemore. His focus, technical analysis. Have a great day.